sense to you. How many of you think you're a normal human being? How many don't? Normal human beings are predisposed to fail in the stock market because normal people avoid the pain of loss and they pursue the pleasure of gain, and that causes them to do things that are destructive, even though it makes really good sense. And if you were at a party and exchanging trading ideas, everyone would agree that you're doing the right thing. But having traded for 20 years, I know that there's certain things that just about everyone does that's destructive to their performance in the market. And that's what I'm going to try to talk about in this next presentation. Or really, it's our emotional attachment to money that is to blame. A few years ago, a study was done where they compared two groups of investors. One group of normal, functioning type people, and the second group was people that suffered from schizophrenia. And the people that suffered from schizophrenia, that had mental disease of some sort, who had no emotional attachment to money, were better stock traders than you and I. Because they just, I think in the experiment they were given a set of rules to follow, and they followed the rules because they didn't have that emotional attachment to money. And it's a little bit disheartening to know that crazy people do better in the stock market. But you start to see why when it goes through some of these things. So we want to lose our common sense and do better. What I've done for us today is just going through some uncommon sense. So the first one, it is better to buy expensive stocks than to buy cheap stocks. What I mean by that is if the stock yesterday was $1 and today it's $1.20, it's more expensive. And some would say, oh, it's an expensive stock, it just went up 20% in one day. But it is better to buy that stock than to buy the stock that goes from $1.20 down to $1 in one day. Now, why is that? Well, a few reasons. We'll talk about them in turn, but here's an example. This is a company listed on the NASDAQ exchange, and at the red arrow, it had a pretty bad down day. It went from $1 to 65 cents in one day. And some would say the stock was on sale. It was a blue light special. I used to work at Kmart. That was my first job. I fronted shelves in the sporting goods department and the toy department at Kmart. And on Sunday afternoons, I would get to haul the blue light special over to the pile of junk that nobody wanted, that we had to sell. We'd put a blue light on it, and all of a sudden, crap that nobody wanted would sell very quickly. Why? Because it was on sale. People take the crap home and they go, geez, I bought stuff I don't need just because it was on sale and it ends up never getting used anymore. I have this talk with my wife all the time. So I'm not big on buying things on sale, particularly in the stock market. Because in the stock market, when something's on sale, it implies, if you think about what stock price is based on, it implies that there's something wrong. The reason people are willing to accept a lower price is because there is something negative going on there. And if you buy stocks that appear to be cheap, you're often buying something that's going to get cheaper. Research in motion is a great example. Here's a stock that's fallen day after day after day for the last couple of years because they're just not competitive in the cell phone business with Apple. And so I would rather buy something that is strong and expensive because it implies that there is good things going on at the company. The fundamentals, or at least the perception of fundamentals, is such that people are willing to pay more. So at the green arrow in this particular trade, the stock went from 65 cents to 80 cents in one day. Something good was happening, and it caused people to be willing to pay more for the stock. And that's what happened ultimately. The stock then went from 80 cents to $2. So the cue in the market, the thing that tells us that there's something going on, is when stocks become expensive all of a sudden. When they go from being quiet, boring stocks, to then one day having some excitement and jumping up in price, it implies that there's something significant fundamentally going on in that story that justifies people paying a higher price, and away they go. And this can happen with a little pharmaceutical company like this. It can happen with Microsoft. It can happen with Royal Bank. It can happen with a penny stock mining company. They're all the same. Next bit of uncommon sense. You, and me included, should not do fundamental analysis. There's many, many reasons for this. I'm going to try to touch on the top few. First of all, none of you in this room have enough information to do good fundamental analysis. Because, assuming you're all normal people, you are not insiders in companies, you are not necessarily experts in a certain industry. You don't have the kind of insight that the big money is using to make their investment decisions. So imagine you're a hedge fund with $20 billion under management. Okay, so maybe you're John Paulson, big hedge fund guy, or Steve Cohen, or some of these huge hedge fund managers that have unbelievable resources at their disposal to make investment decisions. Let's say you're thinking about buying Disney. Well, you can read the news releases. You can maybe watch their movies. Or you can do real good fundamental analysis to try to figure out if earnings are going to be better or worse in the future. Well, if you've got $20 billion under management, you probably have a bit of a budget to do some good research. You could hire some Harvard MBAs to study the financials. You could send some college kids down to the Disney parks to count traffic. Have those kids just sit on benches and count people going in and out of the store and how much they're buying stuff. And then you compare that to what people were doing last year when you did the same survey. You know, there's hedge fund managers that buy satellite time, and they take pictures of Walmart parking lots from the satellite. And from that, they can determine whether the Christmas shopping season will be better or worse than last year. Now, that's expensive to do that kind of work. Has anyone tried to buy satellite time? Take some pictures? It's probably pretty expensive. And so the end result is that those people have an advantage over all of us. Because their fundamental analysis is doing things where they're uncovering private information. They're doing really great work to get private, some people call that inside information. Now, what most of us have access to is company financials, news releases, maybe some media reports that we hear. And those things are great, except that they're already priced in. Because one of the first things I said today was that the stock market is efficient. It prices in all available information almost immediately. And so if you read about ABC Pharmaceutical that found the cure for colon cancer last week, that's great information, but since it happened last week, it's already priced into the stock. And that information is now useless. What you needed to know was that information before the news came out. And you and I probably don't have the ability to do that. Some people do. Hedge funds spend a lot of money interviewing doctors. So if there's a trial being done of a particular drug, they want to go talk to the doctors that are maybe using that drug in the treatment and figure out if it's going to work, and figure out if it's going to get FDA approval, and all those different things that go into whether a drug company stock really goes up a lot. And when they figure that out, they start to do what? They buy. If they have good information, they're going to start accumulating that stock. They don't want to buy it after the news comes out. Because when the news comes out, it's going to shoot up instantly. They're going to miss the boat. So they start buying that stock early. What do you think that does? Well, it paints a picture for us in the stock chart. Because the stock, which may have had falling tops, will switch to rising bottoms. You know, look at Gale Pharmaceuticals, RXI Pharmaceuticals. I don't know why their symbol is Gale. RXI Pharmaceuticals had falling tops here as we go from left to right. The sellers were in control, and then it started to switch to rising bottoms. And then it had an abnormal up day that broke the downward trend line. So all of those things that I talked about are really ways to figure out what the inside fundamentals are. But what you know the fundamentals to be, you know, if you're reading news releases and stuff, you're probably not going to pick up on the important stuff until much later. And the media is almost always too late. The media reacts, the stock market predicts. And so you have to really learn how to read the market if you want to do this kind of analysis. Fundamental analysis shouldn't be done. There's other reasons, I'll touch on them in a moment. Next thing. You can't go broke making a profit. Everyone's probably heard of Jim Cramer, Mad Money guy. Very smart guy, a lot of experience in the market. But one day he said something that I shook my head at. He says, you can't go broke making a profit. He's trying to tell someone to sell stock. Now maybe he had other motivations for selling that stock. Maybe his analysis said it was likely to go lower. But that's one thing that he said, you can't go broke making a profit is totally wrong. Because we now should recognize that we can't be right all of the time in the market, right? We're going to be wrong some of the time. And when we're wrong, we have to minimize our losses. Well, we also have to make enough money on our profits to pay for the losses. So if you take small profits all the time because you say, well, I can't go broke making a profit, I'm up $1,000, I'm going to sell. Well, maybe now you're not making enough on your winners to pay for your losers. So remember I said earlier I had a strategy where I trade the VIX? By the way, the VIX is the volatility index. It's often called the fear index. And there's an ETF called the VXX as a symbol. And it's a great way to sort of hedge the market a little bit. It moves very fast sometimes. But anyways, my strategy on the VXX, right, let's call it 40, 45% of the time. Now, if I took quick profits all the time, if I took my $1,000 gains every time they came, and I had my $1,000 losses still, I wouldn't make any money. Because 5.5, 6 times out of 10, I'd lose 1,000. 4.5 times out of 10, I'd make 1,000. So I actually lose money after 10 trades. However, that particular strategy is effective because when it does well, it can make 10 to 1. I've had some trades make 20 to 1 on that strategy. So now my $1,000 loss is being offset by the occasional $10,000, $20,000 gain. If I said, well, you don't go broke making a profit, I sell my winners too early, I don't get to get those occasional $10,000 or $20,000 profits. And instead, a strategy ends up being a break-even strategy or even a loser. So don't be fooled into thinking you can go broke making a profit. You can't go broke making a profit. Uncommon sense, you don't have to be right more than you are wrong. Now, my wife thinks that I have to be right all the time. And I think that she has to be right all the time. You know how that goes in marriages, right? But in the stock market, you don't have to be right all the time. And I see these internet ads where they say, our trading strategy is right 86% of the time. Well, that only gives me half the information I need. I also need to know how much you lose when you are wrong and how much you make when you are right. Because a strategy that's right 86% of the time that loses, $5,000 when it's wrong and makes $200 when it's right, is not a very good strategy. And so anytime someone says, oh, I've got a strategy that's right 7 out of 10, 9 out of 10 times, the second question you need to ask is, well, what do you make when you are right versus what do you lose when you are wrong? There are strategies that are right 20% of the time that make a lot of money. Because when they're right, they really make a lot. When they're wrong, they have small losses. So keep that in mind. And if you focus on trying to be right all the time, you're probably not going to do well because it also means you won't sell your losers. If you in your head you think, I got to be right. I hate being wrong. I want to have nothing but winners. What happens when you get that bad stock pick that goes down and it tells you to sell it, but you don't because you don't like to be wrong, and it gets to be a bigger and bigger loss. Now, your winners have to pay for a really big loser. And most people, we did a little poll earlier to prove or see this, most people have some big losers in their portfolio because they hate to be wrong. It's okay to be wrong. Just be wrong with small losses, not big losses. Next bit of uncommon sense. Trading profitably is a skill, not a talent. What I mean by that is being a good trader is not something you're born with. Anyone can be a good investor, a good trader. It takes good knowledge, some determination, some hard work, some discipline, emotional control. But don't think that you have to be a genius to beat the stock market. What you have to do is you have to think differently than most people. I always like to say, if you do what everyone else is doing, you will be average. That's the definition of average, is what most people do. You know, in school, you have the bell curve. Remember that? You always want to be on the one side of the bell curve. That's how you got an A. Most people are in the middle. That's the C average. If you want to do what everyone else is doing, you'll get average. If you want to do things a little differently, and I would say that my approach is a little different than what you probably conventional wisdom is taught, then you have to do things differently. Never forget that. Next bit of uncommon sense. Never check the news after you take a position. Alright, so what happens? Let's say you buy RIM. You're watching someone on TV, they say, you know, I think RIM is a great takeover target and you should buy it. Okay, so you go out and buy RIM. You buy it at 20 bucks, now it's at 15. It's gone from 20 to 15, it's gone way below where you should sell. You're feeling a lot of pain, you're losing some sleep. We as human beings are inherently wired to be optimistic. It goes right back to when we were cavemen. How you survive. You imagine being a immigrant in the 1800s coming into Canada and starting a farm in Saskatchewan and it's the middle of winter and you don't have enough food. You have to be optimistic to survive. Well, that mechanism is ingrained in us from when we're young. And so in the stock market, what we do is we look for reasons to feel better when we're feeling pain. So we look for reasons to own RIM, even though the market is telling us to sell. And the first thing that investors do when they have a loser is they go on the internet and they try to go to message boards or to news releases and look for anything positive that makes them feel better about what they've done. So that when their wife says, why don't you sell that stock? Well, I saw this guy on TV yesterday, he says it's going to 40. Well, there might be 30 other guys that say it's going to 5, but you find that one glimmer of hope that makes you feel better about holding that stock. How many people go to Stockhouse after they own the stock and look for glimmers of hope? Now realize that people that post on message boards do so because they own the stock already. Okay, they're cheerleading because they want the stock to go up. So they have a big bias. And everywhere you look for information, you're probably going to find bias. And so the end result is that you seek out information to confirm your position, and it affects how you think, how you analyze that stock. Behavioral finance people call that confirmation bias. And it's a big reason why people hang on to losers. So don't do it. Just don't go look at the news. It's irrelevant. You look at the market tells you to sell, sell. Don't worry about what someone says, what some news release says. If the market is telling you to sell, sell. And we'll look at some stocks, and I'll tell you what to do in a minute, and then I'll also tell you why. Uncommon sense. Let the market tell you what to do. I think I've done these presentations for 10 years, longer actually, and so many times people come up and say, Tyler, that sounded really good, but you don't look at anything about the companies you do. You don't study the fundamentals at all. You don't know anything about what you buy. That seems crazy. And the answer is yes, I know nothing about the companies that I buy. And the reason is because whatever I know won't matter. Because the market will always know more. How many of you think you could beat a Trivial Pursuit game against me? I'm not very smart, so. So one-on-one, some of you may know lots about history, some of you may know lots about geography. Probably could beat me in a game of Trivial Pursuits. But how many of you think you could beat 1,000 people in a game of Trivial Pursuit? You against 1,000. Well, when it's just you can trust that there's someone in that audience of 1,000 that's going to know the answer to every single question. Because it's a big group of people. Well, the stock market is a huge group of people. There are millions of people investing in the stock market. Every little bit of information is out there priced in. And as an investor, you can do unbelievably in-depth fundamental analysis. Study absolutely everything. If you miss one thing that's important, you can be wrong. But the market won't miss that one thing. The The market factors in every bit of information. And so when you let the market tell you what to do, you are trusting the opinion of thousands of people who all are motivated to make money. They are all financially motivated to be right. And that's why I follow the market, because it's more reliable than what I think I could ever do looking at the knowledge out there. As I said earlier, the final thought here is if you do what everyone else is doing, you will be average. So don't approach the market in a common sense kind of way. Because in the long run, it won't work. And it took me a long time to figure that out. You can't be smart. You have to be a good listener. Men have a hard time listening. So think about that. Women tend to be better traders, I think, because they listen to the market a bit better. Guys, we're full of our ego, and it took me a long time to be a good listener. Listen to what the market tells you. All right?